Good afternoon, everybody, and welcome to The Insider. My name is Warwick Lace. I'll be facilitating the webcast today. 1st of September, so happy spring day, and the markets certainly have a spring in their step with yesterday's close posting the 11th straight month of gains for the ASX. So it's been a good period for most sectors. But Australian technology certainly seems to be starting to make its mark on the world, and obviously Afterpay, Atlassian and Canva are obvious names that spring to mind, but there's real excitement for emerging Aussie tech companies out there. And this was a sentiment that was shared by Alex Boslitz, the founder of Thorney Investment Group, who joined us on Friday, where he discussed his listed investment company that invests in tech stocks. The ASX code there is TEK. Alex discussed a number of stocks, both tech and top as well, and we'll invite those companies onto our CEO session, which is today's event, a CEO session, where we give you direct access to the CEOs of ASX listed companies. It's an invite-only webcast. Not any old company cracks an invite to the event, so they've either been tipped or referred as a favorite stock by a fund manager who we hosted at our fund manager session, or they are part of a reference from someone in Reach's network. So by attending a Meet the Manager session, you hear from a professional investor about why they are invested in a company and what their decision process is and investment philosophy behind making that investment. So we think really credible information that helps you make more informed and sort of educated investment decisions. And advisory information contained in today's presentation, general nature, does not consider your personal circumstances. You need to consider for yourself whether it is appropriate for you. Okay, let's rip right into it. This week we are joined by Barden Davis from Peak Resources. And we are also joined by the CEO of Sealink Travel Group, and also Philip Britt, the MD of Aussie Broadband. Peak trades under the code PEK. Sealink can be found under the ticker SLK, and Aussie Broadband, the code there is ABB. So remember to stick those codes into your special Reach Market CEO watch list and stay on track with these companies. First up, we've got Barden Davis, the MD of Peak Resources, a rare earths mining company that is looking to produce some of the key raw materials needed to power low carbon technologies such as electric motors and clean energy and robotic technology. So Barden, thank you very much for your time today. Reach has actually been an active participant in the rare earth space, and we really like the thematic, and look forward to hearing more about Peak's plans. You should have controls of the presentation now.
Okay, great. Thanks, Warwick, and good afternoon, everyone. So Peak Resources is a rare earth focused company, very much aligned to thematics around decarbonisation, the rise of electric vehicles and renewable energy, as well as the need to diversify rare earth supply and, in particular, develop production outside of China. In terms of our focus, we are positioned to become one of the world's lowest cost, fully integrated rare earth producers. And that's by the development of Ngualla, which is one of the world's largest and highest grade rare earth deposits, where we'll produce a high grade rare earth concentrate. We'll take that concentrate, we'll ship that to Teesside in the northeast of England, where we'll produce NdPr oxide and other separated rare earth products. In late July of this year, we announced that the Tanzanian cabinet had approved our special mining license application. And so this elevates us as having one of the highest grade NdPr oxide projects in the world, with a completed bankable feasibility study, low OPEX and CAPEX, an initial 26-year life of mine, which is based on reserves, with all key mining, environmental and planning approvals in place. In terms of a corporate snapshot, we've got a market cap at the moment of around 160 mil. Share prices appreciated strongly over the last 12 months, and that's really been attributable to an uptick in NdPr oxide prices, increasingly attractive sector fundamentals and increased confidence in the market that that special mining licence was coming. Significant momentum over the last 4 months around milestones and further de-risking of the business. So at Teesside, we've implemented a planning permission. We've also executed a 250-year lease over the site. As mentioned, we've received Tanzanian cabinet approval for our SML in Tanzania. We've also recently announced a proposed repayment and termination of the ANRF royalty facility. Last week, we announced the commencement of a BFS update. And then looking forward, key developments are an SPP, shareholder purchase plan, which is scheduled to open on the 6th of September. We've also got a shareholders meeting on the 28th of September, and that's to approve a combination of the second tranche of a $30 million equity raising, the shareholder purchase plan, and the royalty transaction. In terms of our announced Aussie $30 million equity raising, it is 2 tranched. First tranche is completed for circa 20 million Aussie. The second tranche is subject to shareholder approval, and there's a meeting scheduled on the 28th of September. Importantly, we're also extending that opportunity to retail shareholders through a SPP, and as I said, that's scheduled to open on the 6th of September. Part of the use of proceeds of that capital raising is the repayment and termination of the ANRF royalty facility, whereby Peak will pay approximately $10 million US to repay that facility in accrued interest and terminate a 2% gross revenue royalty. What's the rationale for that? You know, we thought it was very important to fulfil commitments that we've provided to the Tanzanian government around the transfer of the SML to a new co that would be 84% owned by us and 16% owned by the government, with no residual liabilities. Importantly, we're also terminating a 2% gross royalty, so that enhances earnings. It enhances shareholders' exposure to underlying cash flows, upside in terms of rare earth prices. But what it also does is it better positions us to achieve attractive long-term project and export financing. In terms of key investment highlights, comprise of a combination of an attractive sector outlook, very much supported by the rise of electric vehicles and wind power, a world-class high-grade rare earth deposit, a vertically integrated business model from ore to NdPr oxide, which enables us to maximise and optimise margins across the value chain. The strategic location of our Teesside refinery, which very much gives us a plug-and-play solution from an infra as well as a utilities perspective. And then I think the final point there, both the Nabala and the Teesside projects have been substantially de-risked from both a technical and regulatory perspective. Next slide. Key point here is that in excess of 90% of projected revenue is in the form of NdPr oxide, which is used in high-strength permanent magnets. The outlook for NdPr oxide and high-strength permanent magnets is being very much driven by the rapid growth in electric vehicles and direct drive wind turbines, which in turn are being supported by more and more countries committing to net zero carbon targets, more and more countries and regions committing to the ban of internal combustion engines. And I'd highlight two specific regions. One is the UK, which is committed to a ban by 2030, and also in the EU, which has announced a recent proposal to ban internal combustion engines from 2035. Probably even more interesting is that final right-hand column. And what we're seeing there is leading global auto brands voluntarily committing to EV targets and the phase out of internal combustion engines. You can see from a lot of those dates, they are not too far away. So in terms of the overall NdPr oxide market, projections of annual consumption rate of around 10%, and very much sort of driven by EV as well as growth in wind power generation. We then sort of translate that to the right-hand side, and that's resulting in projections of the market moving into deficit second half of this year. And for that deficit to increase to around 16,000 tonnes per annum by 2030. So to put that into perspective, we're focused on annual production of just under 3,000 tonnes per annum. From a pricing perspective, we've seen a strong surge in prices over the last 12 months for NdPr oxide. We've got prices, spot prices at the moment, around about that $94 a kilo. Compares very favourably to the pricing assumptions that were incorporated in our original BFS, which came out in 2017, which was predicated on a long-term price of $77.50. What we've done on the right-hand side there is we've encapsulated three recent pricing cases put out by Artemis, which is a leading commentator in rare earths. So they came out with a low, a base, and a high. What's interesting is that if you get up to 2030, under each of those scenarios, you've got prices in excess of US $100 a kilo. And importantly, those prices are expressed in real 2020 dollar terms. One of the important thematics in rare earths at the moment is the strong international support for diversifying supply and promoting production outside of China. So that's really important in the context of securing attractive long-term offtake arrangements, but it's also very relevant in the context of project financing, particularly with respect to export credit agencies, development banks, and government grants. So complementing those compelling sector fundamentals, we've got the world-class nature of the Naguala project. So high-grade bastnasite mineralisation, low in acid-consuming elements and radionuclides, so low levels of uranium and thorium, long life of mine, 26 years, supported by ore reserves, which account for less than 20% of the resource base, low strip ratio, low OPEX and CAPEX intensity. So whilst the near-term focus is very much rare earths, longer-term Naguala has multi-commodity potential. So we've got a lot of barite in our rare earth mineralisation. We've also got very promising intersections of fluorspar, niobium and phosphate. So in terms of the special mining licence application that was announced in July, covers an area of approximately 18 kilometres square, which encompasses our project. We have provided a commitment to the government to transfer that SML to a new co, 84% owned by us and 16% owned by the government. Focus now shifts very much to finalisation of the framework agreement with the government. So that's the fiscal arrangements for the projects, covers things like local content requirements, transfer pricing, taxes, royalties, capital allowances, etc. This slide, what we've done is we've got an aerial shot of the Teesside site. So we've entered into a 250-year lease over a 19-hectare area within the Wilton International site there in pink. Plug-and-play infra and utility solution within 3 kilometres of Tees Port, third largest port by volume in the UK, access to reliable, competitively priced power, reagents, water disposal, waste treatment, etc. Importantly, this area is also within the designated Freeport zone, so that provides tax planning and customs benefits. We enjoy very strong support from the UK government, and that's driven by, one, a desire to reindustrialise the north of England, as well as the focus on transitioning the auto sector towards electric vehicles ahead of that 2030 deadline, and that extends to border supply chains, which we are very much part of. In terms of next steps, we've got 3 concurrent work streams. The first is the negotiation of the economic framework agreement. On the technical side, we've announced the commencement of an update on the BFS. That leads into front-end engineering design and contracting on the EPC and EPCM side. From a commercial perspective, we've been working very closely with a financial advisor for the past few months. It's been getting our model into a bankable form, a lot of progress around comprehensive IM for banks. We've also started early engagement with export credit agencies and a select number of commercial banks. On the offtake side, historically, very good engagement with a broad suite of parties, everyone from magnet producers, electric motor producers, auto groups, and trading companies. So post SML, we're re-engaging with those parties, and we're re-engaging now from very much a stronger position. So that all leads into a target final investment decision by the end of September next year, and then we go into a 2-year build and commissioning phase. As announced, we've commenced a BFS update. So that's primarily around movements in OPEX and CAPEX. It covers a change in flotation collector, as well as the potential to develop a shorter, cheaper access road to our Ngualla project, and also obviously accounts for positive movements in NdPr oxide prices. What we've done on this slide is just recap on some of the key parameters from the original BFS and optimisation study. I think the key takeaway there is that delivered very robust economics and returns, but was predicated on a 77.50 NdPr price, which obviously looks very conservative with respect to spot prices as well as Adamas projections. So, Warwick, that concludes the presentation. If we want to open it up for questions.
Yeah, thanks, Barton. Thanks very much. That's fantastic. We're tracking very nicely. I'll do a quick shout out to be booked into our next Meet the CEO or Meet the Fund Manager session. Just type in CEO or MTN for Meet the Manager into the questions box now, and we'll book you into the next session. So there've been a bunch of questions that come through. As I said, there's been Reach has been interested in the space, and I think lots of our network are too. To kick off, why does Peak need to conduct the buyback of the ANRF royalty?
Look, very good question. I think I sort of touched on some of the key points in the presentation. It was primarily driven by the commitments that we'd given to the government to transfer that SML into a clean NewCo structure. If we were to transfer that SML from our Tanzanian subsidiary PRMG without approval from ANRF, that would trigger a default termination sum, which is basically the upfront value of the stream of royalties over the life of the project. So if you put in sort of spot prices at the moment, you sort of end up at something like $150 and $160 million. So we were obviously not in a position to pay that up front. We were also very concerned about the risk that ANRF could sell that royalty to a third party, and that third party could sort of frustrate the transfer of the SML, or even potentially use it as an opportunity for greenmail. So strategically really important to do. We believe that we've structured that deal at a very attractive price. That's also consistent with where the independent expert has come out in terms of their assessed valuation range of 25 to 35 mil, and they've also deemed that the transaction is both fair and reasonable.
Sure. And then just quickly go over the use of funds for the SPP, please. I'll just call out that Hansel and Ross and Jeff have all asked a bunch of questions. We won't have time to go through all of them, but we certainly will share all those questions with you, and you can go back to them in your own time. But the SPP use of funds?
Yeah. So I'm just trying to bring up the slide. So SPP funds are primarily focused around progressing the development of the Ngualla and Teesside projects. We're also very close in terms of finalising some senior technical and marketing hires, and that will sort of give us an additional capital base to sort of fund those key initiatives.
Okay. And then finally, maybe just very quickly, any progress on the offtake and financing front?
Yeah. So look, I think we've sort of covered a lot of the key points. So in terms of financing, as I said, we've been working very closely with a financial advisor over the past few months. We've got a model now that is in a bankable form. We've got an information memorandum that's very progressed, and we've also started early engagement with both ECAs and commercial banks. With respect to offtake, historically very good engagement with a broad suite of parties. The challenge was that you could only take those discussions so far in the absence of an SML. So generally the feedback that we would get is, yeah, we get it. Ngwala is world class. We get the strategic attraction of Teesside. But why don't you come back to us when you've got your SML? So we've now got the SML approved. And at the same time, NdPr oxide prices have improved and sector fundamentals have strengthened. So we're now in a much stronger position now that we're sort of going through and re-engaging in those discussions.
Barton, thanks very much for your time today. We'll keep on moving along, and we turn to Clint Furherd from the CEO of Sealink Travel Group, which is Australia's largest integrated land and marine tourism and public transport service provider. Sealink was introduced to us by Nick Gudera from the L.E. Griffiths Group as one of his favourite stocks in their small and emerging companies basket. So great to have you on with us. Nick provided a really compelling case for Sealink. So looking forward to hearing from you about how you've been travelling, if you would excuse the pun. And you should have controls of the presentation now.
Great, thanks Warwick, and welcome everybody, and thanks for joining. As Warwick said, we're a bit of a unique business on the ASX. Australia's largest integrated land and marine tourism public transport provider, and we have established operations in both London and Singapore. And we're looking at one of the Singapore public transport buses there on the screen. To give you an idea of size of the group. On an annual basis, we move about 200 million customers a year across the network. Our employee base is about 9,000 employees, and we operate about 3,800 buses, about 120 vessels, and 24 light rail vehicles. Our market cap is about $2 billion. We're an ASX 300 business, pushing on the door of ASX 200, hopefully very soon. And as far as share price performance, share price is up about 100% over the last year, and that is a function of some of the underlying characteristics of the business, which I will hope to talk to today. So what I thought I might do is just talk to the financial performance of the group as it relates to the underlying fundamentals. I think I can talk about the characteristics of the business. But I think it's most powerful when we see that translate into financial results. So just firstly, on this snapshot page of our FY21 result, you can kind of see the quite significant improvement from FY20 and FY21. And the first thing I'd like to point out here is there was a major acquisition undertaken in the early part of calendar year 2020, where the business bought the public transport operations of Transit Systems Group. So our FY20 result had 5.5 months of trading of that acquisition, and then the FY21 is the first full year of Sealink in its new form, which is both marine and tourism and public transport and being an international group. So you can see the scale of the business now, revenue approaching $1.2 billion, about $167.5 million of underlying EBITDA and nearly $75 million of net profit. I think one of the really kind of core strengths of this business is its ability to generate immense operating cash flow. And through the course of the year, even in spite of COVID, a lot of that cash has been poured back into the business to improve the asset base, keep the balance sheet strong. You can see leverage there of only 1.4 times EBITDA, and enable the directors also at the end of the year to declare a fully franked final dividend of 9 cents per share, the highest dividend that we have declared, and taking the full year dividend to 16 cents. So, I guess combined with the share price and the financial results of the last year, quite an impressive performance. Given that we were kind of plagued by COVID throughout the entire time. So, if I just touch on then, the three reporting divisions of the business and talk to some of the characteristics underlying those divisions. I think that will speak to the testament to the quality of the earnings that come from these divisions. So our biggest division is the Australian Bus Division, and here we operate contracted public transport services on behalf of state governments in every state of Australia. Most capital cities we have an element of operations, and these are quite large contracts, usually for geographic areas of capital cities. And we get paid a fixed monthly payment to deliver these services. So, the counterparty is obviously the state government, so very high quality contract counterparties. They are long-term contracts, typically, in the order of 8 to 10 year contract lengths. And there's an annual price. So we get paid to deliver the service. There's no fare box risk. So, during COVID, obviously we suffered quite drastic patronage declines in this division. But of course, we're collecting fares on behalf of government, so really no effect on our overall revenue. And the business is mostly capital light. A lot of the time, the assets come with the contract themselves, and so we lease the assets from the state government on a peppercorn rent. So very much an infrastructure kind of services provider like business. And the Australian Bus Division, produces about 60% of our overall revenue. In my opinion, the contracts that sit within this division are some of the best public transport contracts available in the world. About 22% of our revenue comes from the international division. Very similar contract characteristics, albeit our operations in London are more capital intensive than they are in Singapore and Australia. But certainly the Singaporean contracts are very similar to Australia. Again, geographic parts of Singapore, with a fixed contract payment, no fare box risk, and still very, very capital light. The Marine and Tourism division is probably the division that SeaLink has been known most for historically since the business listed in 2013. And whilst there is a big tourism element to this part of the business, the underlying characteristics of a lot of the operations are very similar to the other two divisions, in the sense that the ferry operations service 14 unique island destinations around the country. Often we're the only service provider in those locations, and therefore there is a quasi-contracted nature to being an essential service provider to an island. So there is an underlying kind of commuter element to what we do. But there are also some contracted operations within this division. Brisbane Ferry Network, for example, is operated by us and sits within this division. And we also have some resource-based contracts up in Gladstone, providing marine transport to the LNG plants that exist on Curtis Island up there. Some of the strengths of this division for the ferries include freehold landing points and long-term landing rights on islands and the mainland, which provides some level of security and certainty. The tourism operations include Captain Cook Cruises, the Sydney 2000 on Sydney Harbour that most people would be familiar with, the Murray Princess on the River Murray, and also Captain Cook Cruises on the Swan River in Western Australia, including also the Rottnest Island ferry. So just talking now then to some of the period highlights and what all of that kind of translates into. I suppose the financial result demonstrates the resilience in the essential services nature of the bus contracts. Great time to have a government counterpart. The revenue has certainly kept flowing through the course of COVID, and the underlying earnings of the business have held up particularly well. I think one of the big differences with our business to most others in our sector is the immense organic revenue growth that we have access to. So just this year alone, about 175 million of our turnover either started or secured, purely organically, no capital required. This is us being awarded additional contracts. On the marine and tourism side, because we operate to those very iconic destinations around Australia, I think our destinations have been very highly sought after. So we've really capitalised on the heightened domestic tourism demand. Of course, there was a period where there was lockdowns across the country and nobody was travelling at all. But certainly, when borders relax, our destinations seem to benefit, more than most, which we're very fortunate. And the business is a very efficient business. We win organic contracts by tendering, and we do have to be the best value for money offering. So cost-based efficiencies are particularly important. And you can see there that there's a number of contracts that have been secured or started over the course of this year. We've doubled out the size of our business in Singapore this year, and we've won some really key marine contracts. And I mentioned that Brisbane River CityCat contract that commenced in November last year, and now quite an icon within that marine and tourism portfolio. I'll talk in a second a little bit about the pipeline of contracts, and there's some contracts that we've got waiting to hear about. But the other notable move that the company made through the course of this year was the acquisition of Go West Tours in Western Australia, and that's our first move into resources transportation. So that opens up another avenue of organic pipeline contracting opportunities. The final point on this page here, flows nicely along from Barden when we were talking about electric vehicles. This is something that where we've emerged as the leader in Australia, moving our fleet to a zero emission transport solution. We've placed the largest order in Australia for electric buses, and by the end of FY22, we hope to have at least 55 purely electric public transport buses in our portfolio. In addition to that, there's a lot of R&D going to hydrogen fuel cell and electric vessels to complement our marine portfolio. This slide here, really kind of talks to where the company is positioned, and as we look to the future. So certainly, the focus for us is organic growth. This is the really powerful part of growing a business like this, and is why the share price has appreciated in the way it has over the last year. And it's the delivery of that organic growth within the business that doesn't require any further external capital. So any of the contracts that we win and the earnings that we derive from those contracts all flow to the existing shareholder base. We are a very customer-centric organisation, and obviously happy customers translate into more work for us. So there's an ongoing kind of focus on customer investment as an asset class, but also we're investing in our broader asset base using some of that free cash flow that I was talking about earlier to complement and build on the asset base that we have. So as far as organic growth opportunities, focus on domestic opportunities, leverage our Go West footprint in the resources space, and also we have an international expansion strategy. So we're looking at a number of different markets overseas, New Zealand, United States, and further expansion in Europe is of core interest to us. M&A is an important part of what we do, but it's not essential. It's a catalyst for opening up additional organic growth opportunities like the Go West acquisition, but it's not a primary source of our growth. As I mentioned, the organic growth in the business is the primary source of growth. So in addition to M&A and focusing our growth, obviously, the ongoing management of COVID is pretty important to us, both for our customers and our staff. And we continue to look at all safety aspects related to COVID, and vaccinations obviously is a big topic of discussion at the moment. But more than anything, we're targeting those opportunities that are coming out of COVID. So we are already doing a lot of additional services, airport transfers, those sort of things, and also additional services that require further social distancing. So Hopefully that gives everybody a bit of a snapshot of the core fundamentals of the business and how those strong characteristics of the contracted earnings base are translating into very strong financial results in FY21, and no reason to think that that's not going to continue. So I might wrap it up there, Warwick, and before I do, just kind of point out that the picture that we're looking at was obviously taken in happier times. There's not much social distancing happening on that top deck, but certainly a pre-COVID photo.
They're rather stark, the differences between pre and during COVID photos, I must admit. So on that point, just when domestic borders are open and domestic tourism sort of resumes, how quickly do you think that market will bounce back?
Yeah, well, I guess fortunately we've kind of been through this before. So in 2020, when the whole country was locked down, it was certainly the big question that we were asking ourselves when we were kind of placing a lot of these tourism-based businesses into hibernation. That Barrett Ferry there is on its way to Rottnest Island, and that was one of the businesses that was suspended. And what we saw was that the demand sprang back incredibly quickly. I think locking people down creates a bit of a travel bug, and we certainly saw the demand come back very quickly. We experienced very strong intrastate demand, even when state borders remain closed, but individual states open up. So I think we're pretty well positioned. We've retained a lot of our workforce, and we continue to schedule services. So our expectation is that this year is going to start a little bit later than last year from our summer peak period. We expect that to start in December, as vaccination rates increase and borders start to relax. And we expect to see a much stronger second half, which would otherwise be a bit softer. So we expect to see that summer period demand continue through February and March and beyond Easter, whereas we would otherwise see a bit of a softer time that time of year. But certainly, we're very well placed to capitalise on that relaxation.
In terms of contract tenders and the pipeline, has that sort of stayed active? And just a comment from Ken around sort of competitors in the space. What's the competition like at the moment, and how full is the pipeline?
Yeah, there's an enormous pipeline of opportunities. We've got a couple of tenders in at the moment in Sydney and in Melbourne, waiting the outcome. They're quite large tenders. To give everybody an idea of the size of these things, they're kind of in the order of $150 to $200 million of turnover per annum if you're successful in these contracts. So we're waiting on those. Darwin's out for tender for the whole city at the moment, which we're participating in. And Sydney has just announced a further 4 tranches of contracts, again in the order of $150 to $200 million of turnover per tranche. So, we're looking at a number of years of very aggressive kind of tendering across Australia, and the similar kind of situation exists overseas as well, and the opportunities within our Singapore business are similar, and also, we're ramping up on some tenders in the UK at the moment as well. So it's a pretty bright future. As far as competition goes, largely it's the large multinational operators like ourselves in this space. The mix of companies really hasn't changed too much, and we've been doing what we're doing for the last 25 years, using a very successful formula to win more of these contracts than any other company in Australia. So we're quite confident in the competitive landscape.
Yeah, very, very good, Clint. There are a few more questions, but I think we'll forward those on to you separately, just in the interest of time. And thanks very much for your time today. Good to get the full story.
Great, thanks for having me.
All right, and next up we've got Aussie Broadband Limited, an internet service provider with a reputation for providing high-quality internet and transparent customer service. ABB was also introduced to us by Nick Goodera from Ellie Griffiths, and as one of their favourite stocks. Philip, no doubt some tailwinds blowing in your favour over the past 18 months or so. I would imagine that's going to be good to get an update from you, and you should have controls of the presentation now.
No worries. Thanks very much, Warwick, and thanks everyone for joining the call today. Aussie Broadband is Australia's 5th largest NBN provider, and we've actually been around for nearly 18 years now, but it's really only been the last few years that people have really known about us. we started off life as a regional Victorian-based business doing wireless access and so on. We made the decision about 5 years ago. It was either time to get big or get out, and this is as the NBN was sort of flowing into the area. And thankfully for myself and our other shareholders, I think getting big was the right approach. If we look at sort of how we've achieved over the last 12 months, we've had significant revenue growth, 84% growth in the last 12 months, significant EBITDA growth. Our broadband services, which is our core fundamental connectivity and so on, 53% growth, so up from 261,000 last year to over 400,000 today. Our fibre network, which I'll talk a bit more about as we progress through, has made it now to 28 NBN POIs. NBN is broken down into 121 different geographic areas, and if a provider wants to service all of Australia, they need to connect to those 121 areas. And we do that today using other carriers' networks, but we're building our own to basically improve margins as we go. Mobile's a core part. We've seen a lot of growth in that area. And business is playing a big part as well. Traditionally, residential has been sort of the bread and butter of the business, but looking after small, medium businesses and now into the enterprise space has also become a key focus. Customer service is at the core of what we do, and last year we won the Pinnacle Customer Service Excellence Awards for large companies, which we're very proud of. Our team are an absolute core part. We call them our family, and 86% of them say that we're a great place to work, which puts us in the 16th highest great places to work for medium Australian businesses. And we're a real technology company. So whilst we're a telco at heart, our technology platforms enable us to grow. And today, the figures there are at 30 June, but today there's about 600 of us in the organisation, predominantly in Victoria, but we do have a new call centre that's just starting in Perth, so we can do follow the sun style support. If we sort of look at the growth over the time, our broadband services have grown dramatically over the last 5 years or so, and regular sustained growth. Churn is a key factor and a key thing that people model in this space, and we have some of the lowest churns in the industry. Mobile service is a new growth area that we're focusing on, and we transitioned during the year from basically using the Telstra network to using the Optus network. And a lot of people would probably think that seems a bit counterintuitive, but ultimately we've found that that's actually had a higher attachment rate. We've been able to be more competitive in the mobile space, and that came online from May this year. So we're already seeing higher attachment rates in the mobile sort of sector. Customer experience is the core of what makes Aussie great and why our customers choose us. Won a lot of awards in the customer service, customer experience space, and we're the highest rated telco out of all the major telcos in Australia. So it's an absolute core part of why people choose Aussie. In terms of going forward, we're not just a simple NBN reseller. Basically, we do own infrastructure. We're in the process of deploying over 1,200 kilometres of optic fibre into the ground, and this will allow us to connect to 85 out of those 121 NBN POIs using our own fibre. What this does in effect is basically improve our margins. So from FY23 onwards, we'll see a $15 million saving flow through to our bottom line as a result of this project. It's costing us a bit over $50 million to build this fibre network, so the payback is very, very quick. And one of the other benefits to it is that we're able to directly connect business customers to our fibre as we go. So these fibre networks roll out through the various different suburbs. So this is Victoria, heads quite deep out into the outer, suburban sprawl, right down the peninsula and so on. If we look at New South Wales, fairly extensive network going all the way out to sort of Penrith, Eastern Creek sort of way in the west, up to Asquith in the north, down to Miranda in the south sort of thing, Canberra, and then Queensland, again, large coverage, including the Gold Coast sort of area, and then through into Western Australia and South Australia. So this network will basically give us the ability to directly connect business customers, meaning that we can bypass the NBN, and that allows us to achieve margins much greater than what you would normally see out of an NBN reseller. So over the next 12 months, our focus is continuing to build scale. Business is a core part of that. Residential has been the bread and butter, and business has always been part of what we do, but traditionally connectivity has been at the heart of that. So we focused on things like just standard broadband connections, private networks, things like voice and hosted phone services. As we move forward, businesses' needs are getting more complex. Security is a key part of that. So we're adding in the security piece, also the cloud piece, and changing the focus rather than sort of selling widgets and that customers then have to try and fit together and make work. Ultimately, we're moving to a solutions-based approach, designing overall solutions for the customer that might incorporate 5 or 6 different products that ultimately, as the collective and managed together, work to make the solution work for the end user. In terms of the go-to-market, we have 4 key channels in the business segment. We have our call centre, which looks after predominantly small, medium type businesses, typically single sites that don't have complex needs. This also acts as sort of an inbound, outbound lead generation system for the relationship team. The relationship BDMs and solutions engineers focus on that sort of larger enterprise space, and it's all about sort of relationship selling over time there. We have our partnership model where we have over 400 managed solution providers. So these are the trusted IT providers of business that typically look after the on-site side of things, and that's another channel we have to market. And then we have our tender team that focus on ensuring we're on all the government supplied tender panels and that sort of stuff. So when opportunities come up through that space, we can tackle it. In the residential space, the focus moving forward is basically increasing the number of products per customer. So this will predominantly be in the mobile space. Typically, when we win a mobile service, we don't just win one service, we'll win 2 or maybe 3. And that sort of allows us to basically lift that ARPU per residential service and grow some margins there as well. In terms of the outlook, we haven't provided any guidance for FY22, but ultimately we're off to a very good start. We had a record sales month in July, and then we've backed that up with another record sales month actually in August. So a big part to it, there's lots of prongs of growth here in terms of we've got all of our direct channels. We also have a white label agreement in place. So Origin Energy's broadband solution is actually provided by Aussie Broadband now. We've recently started bringing them on board, and we've got 32,000 of their customers to bring on in the second quarter. So that's another big growth channel. In terms of the key risks, the NBN pricing methodology is one of those, and that's the main reason we haven't called out any guidance here. So that's pretty much the presentation wise. I'll open to questions.
Thanks very much, Philip. You've stepped through that in record time, I reckon. So fast, not just in broadband, but in terms of investor decks too. Just on sort of a general comment around Aussie Broadband. What do you think makes yourselves different to some of the other competition out there? What are your priorities and focus areas where you measure yourself?
Look, ultimately, the customer experience is the main part. Telco's traditionally got a terrible name for customer experience, and the key thing we do, and it's actually really simple, but we don't have our team use any scripts, and so when they're talking to a customer, they're having just a normal everyday human conversation. They can tailor the conversation to however the person's dealing with them. If the person's fairly casual and loose in how they talk, they'll be pretty casual and loose back. If they're very formal, then they'll be more formal. And what they focus on is, we say, put yourself in the customer's shoes. If you were receiving this customer experience, would you be happy with that? And that ultimately is what makes the difference, because pretty much every other telco in the industry is very scripted. Traditionally, it's overseas call centres. All of our call centres are based in Australia, predominantly in regional Victoria. And that's, I think, the key part. The other part is basically what the product says on the box is what it does. We deliver really fast internet. it's very high quality. It works when you want it to work, and it's just really simple, good old-fashioned. It does what it says it's going to do. Is what it boils down to.
Right. Maybe just again a general comment on the environment. Obviously, work from home, sort of homeschooling, and the like have all been forced upon us. How much of that was sort of how noticeable has the difference been from sort of pre 2020 to now? And do you think it's here to stay?
Look, I think it's really focused people's attention into what they do have at home, whether things are good or bad in terms of their services. I think we'll see a hybrid working model continue for some time and probably continuously. I think people will definitely be back in the offices, but I think there'll be a lot more opportunities when perhaps they're having a slightly off day or just need a day out of the office. It'll be perfectly acceptable to work from home. In the early stages, it drove quite significant uptick in sales for us. We believe those sort of tailwinds have now passed, but ultimately, how good your service is at home is well and truly front and centre in people's minds.
Mm. You mentioned NBN pricing model as a key risk, so therefore no guidance. Any other key risks, and where do you think you might land with the NBN sort of pricing model? Any guesses?
Yeah, look, the main one is that NBN component, and the way it sort of works is there's two parts to the charge. There's essentially a fixed fee based on the speed that we provide, and then there's a variable component which is called CVC. And so, as people's usage goes up, then so does the CVC expense. And where that plays out particularly strong is when we're in lockdowns at the moment, usage increases dramatically. Now, NBN are doing some things to offset that and providing credits, but it's not covering the full differential. And so, ultimately, the industry as a whole, and we're certainly one of the loudest voices in that, is basically advocating that the usage component needs to disappear and move back just down to a single access pricing. The ACCC is now heavily involved in that, and I expect we'll see some movement in that in the next sort of 9 months or so. But it is the number one key risk in this type of business. The other sorts of risks are really around retail competition and that sort of thing. What we see is that from time to time, NBN will run promotions and different providers kind of win or lose from that. The saying I'm using at the moment is the house always wins in terms of NBN. So some will, if it's a speed-based promotion, some providers over-index on high-speed tiers, which is what we do, and so we tend to win with those. But there will be other losers out of that as well. So I think NBN needs to stay in the wholesale space and play less in the retail space.
Okay. Perhaps just a final comment. Life as a listed company, what are the benefits? What's the upside, and how have you found the transition?
Well, it's certainly been interesting. I've never been a listed company CEO before. I've been in private business pretty much all my life. But no, look, to be honest, it's been pretty good. It certainly helps when we've had pretty much nothing but good news to report. So generally, the markets have been quite supportive, and these sorts of investor things have been quite well received. So it's been good so far. Might be different if there's some bad news, but our philosophy, one of our core values is no bullshit, and that's how we basically approach the investor side. And we figure we tell the good, the bad, and the ugly, and then at least we're clear with everyone.
That's it's the only way to do it, and we certainly absolutely support that from our side. It's much better to be upfront and honest and direct, and weather the good with the bad, and it certainly has been good. And I see Ellie mentioned you in July, and anyone who listened into that recording would have done well to take heed of what he said, because it's been a very strong run since then. Thank you very, very much for your time today, Philip. I've certainly enjoyed all the presentations, Barden, Clint and Philip. Very thorough and insightful presentations. Thanks obviously to Nick from Ellie Griffiths for making the two introductions there. And I'd really encourage you to go back and watch those replays on our website. And that's all from us today. Thank you very much for your time today, and we hope you enjoy the rest of your day. Goodbye.